So, okay, the question. I know we talked briefly about what makes A+++ trade, but I forgot to ask you, how do you rank your A plus trade, B trades, C trades? I mean, do you literally have a list of A+++ trades, A plus trades, B trades, and C trades? I know that no two trades will ever be the same, but you have specific setups. Specifically from the setups that you show me, could I assume that the A plus trade is a trade from previous established value area CVA or PVA? B trades might be the trades based on the developing value area DVA, and trades rank at C trades something below that. I know it's also complicated by the confluence and dissonance of other things. You might be looking at the charts. I was just wondering about this because I know that you want to rank your trades to determine how much you want to risk. Yeah, number of contracts to trade. But do you literally rank your setups from A to C, or do you determine that as the specific trade develop, or both? Hey, this is a very good question, and uh, let's go and go from the just a second. Go from the just a second. Presentify. Okay, let's go from simple examples. So, what we have here as a setups, we have from the uh, previous, no previous, sorry, from the uh, established value area, we use breakout pullback setups, and we use return pullback, and from developing value area we are using extreme fade setup, and we are using imbalance pull back setup. Now, setup as a setup, it's not ranked as A, B, or C play. You forgot, actually, you are on the good track, trail, but the point is that you maybe forgot what I was repeating a lot of time, that context is the king. So let's go and use some, let's say some at first simple example. So let's see that let's say this is our some CVA. We have CVA value area high, we have CVA value area low, and then our price is coming like inside, and now what we have here, we have some move. So this is return pullback setup here, right? Let's make these setups green. Right here is entry for the return to clear this and not clear all. This is question. Okay, let's say this is a return pullback setup here. When we see a momentum shift and the bounce from the value area low. Now, when we come here, up here, this is target. So by the rules of market dynamics, we have a lot less opportunities here. And let's note this as a plus setup. So by the rules of market dynamic, they are fulfilled. So we need to wait what will happen here. And let's say we will print something like this, you know, and then here, and you can recognize this as a head and shoulder pattern. And this is what from the price action, a lot of people is using this pattern, and actually they are losing the money on this pattern because this works only at some important levels. You should not use this pattern to trade on in the middle of the nowhere. But in this case, for instance, as we bounce from the value area high, so this is some of our reference level, we break above and then sharply go down back into the value area, and then climbing up to the again to the edge of the value area. I'm more inclined to take this as a short trade here. And this is not setups that we learned here. It could be actually, but let's ignore for now, for the sake of simplicity, let's ignore developing value areas and use just major value areas from our lesson 2 on market structure value areas. So I'm more inclined to go short at this level here. Sorry, at this as this develop here, and what is mechanics in behind that we go into the resistance, we bounce down a little bit, then we break above, and what's happened actually that buyers from the auction market theory, buyers are not interested anymore to pay these higher prices, and the price and sellers, as we are outside of the fair price for this composite value area. Actually, any value area is fair price. So buyers is not interested to buy these higher prices at these higher prices, and sellers is sure interested to sell at higher prices, or at least at higher prices in the upper part of the value area, and then we broke back inside, and this could be our but for the sake of simplicity, let's this is the clean moves like that, you know, and we are in the so sellers step in. This is last try for some sucker buyers that don't understand where we are, and price will most probably start to go down. And now the question is, how we rank this setup here. Now, this is the good question, you know, because what's happened, we have uptrend on the market, you know, and what we need to watch now is the context of the market, you know. So these setups, it's uh, let's say it could be B or C setup. You know. Let's say it's from this perspective, this is C play, C setup, you know, because market is trending up, and this is possible, not it's not secure, you know, but also it depends, of course, if so you need to look left on the left side. If we come, let's say, from here, something like this, into this position, then this is C setups for sure. But if we come from up here, you know, and break inside and then go up, then you have actually on the higher time frames, you have moved down, you know, and pull back. So in this case, as we are again, I repeat, as we are in a shorter time frame, we are at a target, but this is B play, B kind of play, you know, and price is have much higher probabilities it will go back down here, and now we have again this area here where we are searching for the next setups and next play, and and this in this case this is a return pullback again. You know, we didn't break out, we break in actually, and from the what JJ teach in his zooms, this is uh, he calls this a look above and fail. But a bigger picture is actually why this happens here is because the market is trending down on the bigger picture, you know. And if we are stick to the shorter picture, then this is just rejection from the higher zone. We are coming down, and at this level now we need to monitor. It depends again. What is important? Always, never ever lose the woods for the trees. Context is the king. This is number one rule for the ranking setups. So in the shorter picture, in the bigger picture, this is B setup, and we are pulled back. It could actually be even A setups, but it depends on the higher time frames. And on the now again, it depends from the general bigger picture, general market moves. So on the lower part of this move, now we are watching for the some sort of acceptance, and let's say the market will do something like this, you know, maybe break above, maybe break below, sorry, and then it start to go up. And what is happening, you know? We can go long from here, as we have acceptance picture above the level, and each level is zone, so keep that in mind. We can go long here, and in this case, again, context is the king. If market is going from below and we are going tested, then this is a setup again, okay, on the long side. But if market's going above, tested here and come back here and breaking here, you can go short. You can go short, and this is in this case is but sure, you need to wait for the break below the level. So if market is okay, let me repeat. If market is going from below, so this is up move general, this is a setup. But if market is come from above, pull back to the very high, going down, we are and price start to move down here. You can take this is fake breakout on from this smaller short time frame balance zone inside day balance zone, so you can get into short here, and this is in that case this is some sort of the B setups because you are anticipate breakdown, but A plus setup in this case will be if let's make this longer. If market is doing something like this, bounce up, come back down, retest, and keep going down. And in this case, this here on the momentum shift going down, this is A plus setups. And now, what's the difference between A plus setups and between A plus like usual daily setups and what's the difference between A plus and A plus plus plus? So the biggest stronger move. This on the other side depends on the on the much more on the higher time frames like weekly, monthly, quarterly, or yearly. Let's say in this case here, let's put it in this case here. Okay, market come from the above. Let's say on the yearly, we come from the plus second deviation. We are coming down, breaking the CVA, and then bounce back, and this, let's say this is on the yearly, it's some plus 1.5 deviation. On the quarterly, let's say this is year. On the quarterly, this could be a level, let's say +1. So we come here, we bounce on the quarterly from the 0.5, bounce up to the +1, then we're going down. In this case, these setups here becoming A plus 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 setups. It's not B or C setups, but A plus plus plus. Why? Because the higher time frames, we are following the higher time frames, and we actually fading the shorter, lower time frames. But you have to keep in mind that on the yearly, some when you are at a level, this level means 50 to 70 points range, you know. So to access the trade from the higher time frames, we need to closely monitor the lower time frames to get the best possible entries in these trades, you know. So it is something like this play, and this setup also become a plus plus plus, as this is continuation play. Uh, Continuation play, and usually it happens second day, um, because this moves in CVA. CVA is always a few days, 2 or more days of the balance zones. So this is usually is second day play. Second day play, and we are expecting when it start to go down, we are expecting as I was teaching you, we have one CVA. When we break out of this CVA, you know, prices tend to go to the next level of CVA, and then we watch what is happening. And what is probably to happen, we come from our pre-market preparation, so it will to read what is the most probable move is coming from the higher time frames, and we are working our way in our preparation for the day. We are working our way top-down approach. So we are working from the year, quarter, month, week. Then we have CVA. Then we have previous day value area. And then we have our developing value area that we are using mostly to access as a shorter time frame to access. This is our actually trading time frame, and we are accessing trades from this time frame. So what mean in general moves? Let's say we have some of our DVA. It's like going like here, and you have plus 2 as well here, and this is our VWAP is going, and we have something like this. And what's happening? We actually these setups become, or from DVA it become fade extreme, and it's we have confluence of the composite value area high, 1.5 deviation on the yearly charts. We have +1 on the quarterly charts. It could be also some confluence of the, let's say, previous day, like here it could be previous day value area high, and all these things. So what I'm telling you right now is that we are actually doesn't have some sort of as you wrote in the book or in our playbook, we doesn't have our setups is not ranked in a playbook. It's ranked in a grade in the playbook. It's grade in the market itself. At the moment, we need to read our market to determine how good is our daily daily context to use any of these setups. And these setups is in our playbook we actually have these setups as a way how to we are using this as a way how to access the trade, accessing the trade. So again, I want to accent this: the context is the king. Context, never forget, never lose the wood for the trees, never ever. This will lead to excessive losses. This will lead to especially uh, if you are not afraid to take a trade as you are now, because you understand the things, uh, it could lead to re-enter and to just building the stops, full stops, because it will not work if market doesn't agree with your thesis, and actually you put the wrong thesis. In this case, you put for these setups or way how to access the trade, you are putting a wrong market read. So you need to rank your setups and your trades from the full picture of the market, the knowledge you have right now, and and rank and distill. The point is that when you have confluence in all time frames, and this confluence could be, as we talk, could be price confluence or direction confluence. Then when you took the setup from some reference level, it doesn't matter, is it breakout, pullback, return, pullback, or as setups for we are using for established value areas, previously established value areas, or extreme fade or imbalance pullback that we are using for the developing value areas. It could be at the same time, it could be extreme fade on the, let's say, yearly chart, and on the CVA, it could be return pullback or breakout pullback at the same level, and you then you have let's say a confluence of the price levels, and on the monthly or weekly you have maybe you are already inside the value area, so you have and you have so you can have confluence of the directional confluence. This all these confluences making a setup stronger, so it's going in ranking up. It's going to A plus 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 setup, and if you have some sort of dissonance, and as I explained to you, the big difference between amateur traders and normal human beings and traders is and knowledgeable and professional traders is not how they handle confluence, but it is how they handle dissonance. So you need to rank and distill your reading on the market generated informations, and you need to take your directional bias for the move, for the setup, and sometimes market is just not clear, and you can see also that if you have dissonance in a way, let's say it's not each dissonance is the same. So if you have, let's say, dissonance that is close, let's say in 15 points, you can expect something like this, some chop in this dissonance, and you need to wait to market to open to resolve this dissonance on the upside or on the downside. It doesn't matter. What you read in this dissonance, what you read, you can prepare yourself for taking again setups that I teach you. You can prepare yourself for taking these setups from the higher time frame charts, because this dissonance is more probable it will be resolved in the direction of higher time frame charts than lower time frame charts. So you can prepare yourself. But if another sort of dissonance is this is bullish bullish zone, and then you have bear zone, and let's say the distance range between this zone is let's say 70 points. Then this dissonance is not so important for our day trading, because if price is going here, something like here, and you have from breakout from the previous day value area high, you have enough of the move on the table, enough range on the table to before the traders from the bear zone step in and start to push price down. You have at least, let's say, 40, 50 points of the move here. If this previous this level is some maybe 10 to 20 points from the bull zone, and so this dissonance is somehow easier to solve than this one that is close one to other, and what we usually see here is a very, very hard chop, and we need to just we need to see resolve how it will resolve. Okay, we call this we are waiting for market to open and to go in one or other direction. I hope it's clear now how I'm ranking my setups and my trades. It's a fluid. It's a bit different than videos I send you from S&B Capital, because they are trading equities, and it's some other powers and other interests moving in equities than in futures trading, future markets, and so we need to adapt for the proper using our knowledge and our setups here, and that's it for now. If you will have more questions, just shot it. I hope it's clear now how we rank our trades and our setups at the moment we are taking them. And of course, this reading from the market, then it gives me proper reading on the risk and proper reading on the how much I will size in, and again the number of contracts is, as we learned in lesson 3. It depends not only on our setups, on the rank of the setup, but also on the market volatility at the moment, or also it depends on the how much we have, how clear are the moves, how clear is the rhythm, Do we have a lot of overlapping candles? So this is we have some chop in very small ranges, few points. Then you will need to use bigger stops and smaller size to stay inside your risk parameters. But if you have a plus 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 setup, this is a huge thing, and especially if all time frames is in line with at least directional bias, if not sorry, at least in directional confluence, if not in price confluence. This is huge thing, and these setups will give you extremely good risk rewards. It could go even to 30 or 40 to 1 risk reward. So your with proper reading of the market context, you can decide uh, to use eventually smaller stops and get in based on the short time frame on the rhythm, using also, if it's possible, if it's in line, using order flow tools. And you can decide to eventually go to give more tries if they stop you, because the risk reward is huge. And on the other side, you can decide to go just based on the just clear rhythm. If order flows is off, it's not following the proper moves as we see, as I teach you. And then you have maybe bigger stops, but you have to decide at that and in that case that you will give this trade less tries, if they stop you. Generally, between three or five tries, if it's okay. But again, this hugely depends on your daily loss limit that you put as your risk parameter, and how much you're sizing in. And of course, um, we can, if this is something like micro chop, we can use techniques of sizing in, not going full in as we usually do, but rather sizing in, go with one contract, then add another one, then add another one. And so if we will be stopped, we will at least have a smaller use of our daily loss limit, so we can keep going for the day. It doesn't matter. It doesn't matter if we are right. The mathematics of the trading is just mathematics. This formula of expectancy formula does not care about your thesis and are you right or not. I just care about how how do you well handle your execution at the moment. So that's it. That's it.